Good morning.
I'll seek a motion to approve the agenda. Seconded.
All those in favor?
I say they seconded. I'm sorry.
I was waiting for that part.
The first action item on our agenda today is updates to statement of policy for the disposition of real property by Al Eccles.
Morning, Chair Allen, members of the committees,
Chair.
acting chair. We're here today with updates to the board's statement of policy concerning the disposition of real property. And just as a reminder, the board's statement of policy covers a range of topics, but today we're focused in on the element that is the policies reflecting core values of Loudon Water. Just wanted to point your attention to the fact that the board does reserve the right to amend or modify these policies and interpret the meanings or statements made therein. But today we wanted to talk about this section 2.4.1, which is the disposition of real property. And I just wanted to point out that the management and disposition of the authority's real property is a power that is granted to this authority through the Virginia Water and Waste Authorities Act. So you may ask, why do we have this additional policy statement over and above what the act provides for? And really, we feel that, and the board has felt in the past, that we need some guidelines governing the exercise of the powers that really help us with a consistent process of evaluating requests as they come in. But we're here today because we've identified the need to really make some adjustments that provide greater flexibility and allow us to implement the policy with a bit more ease. And so I'd point your attention at the right of the slide. Our existing policy it's fairly succinct as written. Right now, it's fairly prescriptive in that it really rests this power in the board. The board will identify properties periodically that may be available for some different disposition. And then it goes on to say, the board further shall, and it gives a prescriptive list of items that should be undertaken in all cases. And so really we're here because not every decision or real property disposition question that comes forward warrants the same level of detail and analysis and processes. So we've worked with council to develop some red lines. It's not moving. If you can just advance to the next slide. Thank you. So these are the changes that we're bringing forward this morning. And what we've done is in the intro to the policy, rather than the board initiating actions pertaining to our real property, we've modified this that staff will make determinations periodically if a property shall be evaluated. And then we've made some further edits to this middle section of the policy that provide for more flexibility. So rather than mandating we undertake certain actions, this is really providing us with a list of items that we may enact in order, depending on the question at hand or the property that we are evaluating. So it goes on to talk about items that we may do, such as master planning, developing a plat that is appropriate to conduct the evaluation and determine the disposition of the real property. You can see there at the end, we would obtain an appraisal if that's deemed necessary. And so we go through all of those steps. And then the idea being that we will bring the item forward to the board for initial input and authorization to proceed. We would then move into a negotiation process, and that would be conducted by staff and the general manager. And then we would come back to the board for final approval for any conveyance, lease, or other disposition of the real property. So these are the changes before the committee here today, and I'd like to pause there and open it up to any questions or input.
One question, when you use the word staff, does that also apply? Would you interpret that to also mean council? Because at the end of it, you've got sale or lease disposition shall be negotiated by staff and then approved by the board. But some cases you may need to be represented by council. So do you see that use of the term staff to be an extension to our council, which is clearly not our staff?
That's how we interpret it, and that's how we've typically handled any requests that have come forward in the past. We'd be certainly open to amending this language accordingly if you committee feels that we should add that clarification.
Does anybody else have any questions?
Yes. So one thing that comes to mind, excuse me, we had a situation where the property owner came to us and said, hey, how about this, that, and the other thing? This is all and so forth. Again, this is probably broad enough that you could say, well, we can respond. But I'm asking, sometimes people like to interpret these kinds of policies very stringently.
Mm-hmm.
Who's doing the interpreting? And so I'm just asking a question if it would be helpful to make the owner approaches us.
Alton, it's Sean Kelly. Can you hear me? Okay. I had a question.
I'll change it.
I think it's frozen.
And we had also talked earlier. What else can do? It's just take all this stuff that we're doing. We ourselves. If I recall, that's not necessarily.
No, it's a wonderful question and something that we've discussed prior to today. And based on past experiences, we felt that going a bit beyond just the plain language of the act, which is really just one sentence, it provides some guide rails and protections for us in such a way as to, you may recall in the past, we've had various entities approach us, such as solar power providers that want to lease large swaths of our land for long-term use. And we feel that having something more than the act helps us evaluate those with more due diligence and really, make informed decisions and really have some backing to decisions to say no.
and these are slanted towards disposition of property. rather than retention of property, which I think is inconsistent with your goals. There needs to be a change. The question is, do you have simply a one sentence provision, which would be perfectly appropriate, aligning with the act, or to do something like this? I know in talking with staff that they thought building in some of these elective but not mandatory processes was beneficial to them in dealing with third parties who will approach them for the sale of property. Having the right but not the obligation to demand an appraisal, or the right but the obligation to request studies, that sort of thing, would help them in negotiating with third parties who approach us. So that's the reason for that. But you certainly don't have to adopt it. It could be as simple as a one line, the authority to sell, lease, transfer, dispose of any real estate consistent with the code. This gives you the same unfettered authority. What it builds in are optional mechanisms staff believes they might want to employ. You can still do that, but they thought it's useful to have it written down so that third parties approaching us on disposition of property would understand that they may be asked for an appraisal or an engineering study or something else. That you don't have to have it. You could do something very simple, and what's written here is intended not to be mandatory, either on the board or staff.
Mm-hmm. I would just echo that this is what we came up with. We are open to whatever the board feels is most helpful.
The genesis for this.
Well, this all started, as Mr. Campbell mentioned, with the new, the proposal that was brought to us. And evaluating that, we realized that there were some gaps in this policy. I would say, as Mr. Wilburn mentioned, if the board elects to go with one sentence with the Water and Wastewater Authorities Act, I think, staff will want to come up with a procedure that we would want to follow when any land disposition comes up, whether it's initiated by us or a third party, so that we're kind of consistent with our approach and what we bring to the board.
Why is it one of the
We could certainly do that. Yep.
that way?
But the property I just mentioned here, the yips, which is over the yip property, or I don't know what they're calling it now, but anyhow, where they were asking for a little bit of land next and giving us a better access into water. There's so many hypotheticals that I struggle a little bit with this approach, because there's just so many potential, like the deal we did with Nova Parks for the reservoir. How does that fit in something like this? Maybe it doesn't fit in this. But interested way, nothing's happening without support.
Mm-hmm.
Words to circumstances that there's just so many possibilities.
You're saying less is better.
Perspective, just because it's so hard to anticipate what kind of situations future. Frankly, we're easy. Little strip of land. Once. Gives us executive authority. Because of the able to deal with it.
Mm-hmm.
So we don't. And it can be as simple as just following the code. It really can. And that has no procedural requirements. So, I really am sort of agnostic on the two. And that's really, I think, a decision for the board to decide. I know that in discussions with staff, there was some feeling that putting these concepts in would arm them in terms of dealing with third parties. But other changes to the policies we've made over the last year have been tilted towards aligning them as closely as possible to the code and imposing no additional obligations or language requirements in our policies as required. So it could be as simple as one line, and then you just rely on whatever judgment staff has or whatever obligations you want to impose on the third party.
You remember somebody wanted to buy like the front yard out here, and we were like, not interested. But so let's just pretend next week somebody's like, hey, we'd like to buy your front yard. Do you feel we can't just tell them no, or you feel
No,
use that as an example? Somebody wants to buy the front yard. What do you think?
we would tell them no. I mean, as Alton mentioned, we get interest from solar farm for the land over there. We know we have that master planned and is not available. So we would tell them no. I think there a property like we're going through right now where maybe, we're not comfortable saying completely no to that. So we would evaluate it and bring that to the board. But I think there are certain properties that we just know that we have facilities planned for in the future. And so we feel that we can tell them no. But I think there certainly will be properties where we'll get interest from, where we'll spend some time evaluating and then bring a proposal forward to you for review.
And I think there have been many instances where we've discussed with the entity and we've said no, and we've said why we said no, and it's really ended there. And then there have been others where it's been a bit more pushy, why, what do you need? What else do you need? And that's the instances where even in a pared down or defer to the act version of this is a framework that still can exist, and we would in the background likely work through and ultimately come forward to you if an entity was, extremely interested in pushing for more of a definitive answer from the board of directors.
A question just to better understand, because I don't know. Are all policies that you guys abide by approved by us?
No, not all policies.
And you probably have some I don't know what you might call them, but do you have standard operating procedures
Yes.
like SOPs
Yes.
that you write and
Yes.
you guys approve and
Yes.
we don't have to approve that?
Correct.
So this could be that, right?
Correct.
We could do the simple version at the high level and then you guys could put your
Yes. Yes,
in there.
exactly.
What would be the concern with that? Would there be any, really?
No real concern. This was honestly, to your very question, I think these are just more visible versions of SOPs, more public facing.
Is that what you call them, SOPs also?
Yeah, SOPs.
When I was at Capitol Police, that's what we called them. So.
Yeah.
I think I like to keep a simple option at this level, just the one liner, but we'll see where this rest of this board feels and this discussion goes.
Is this more, or it's hard to tell net whether this is more narrow or broad?
Well, I think what it does is some of the stuff like the RFP, and it changes it from required to may. And so I don't know if it's really broader or narrower, but it just makes it, more flexible depending on the situation.
What this does, but also what just using the one line does, maybe more cleanly, is remove all the affirmative obligations on the board. The way it exists now is, and I don't know what the genesis of the policy was on this, it was crafted to mirror the obligations in the Public Procurement Act, which don't apply disposition of real estate. And so you have appraisals and you have RFPs that are mandatory, which wouldn't make any sense in the examples that you gave. And so it's to strip that away. And it really can be as simple as one line. And I know, again, in other contexts, that's what the board has chosen to do, is just to align perfectly with what the code requires and strip away these extra obligations, some of which we don't follow anyway. The way this is set up is the board is supposed to periodically, it's undefined, but periodically review all of its unused real estate and go through this exercise, including RFPs, to let the public pitch and buy it. And we don't want to do that. So it needs to change, but it can either change on just the one line, simple, follow the code, with internal SOPs or something like this. Either one, I think, reach the same goal.
So you support this?
I support either. I'm agnostic on it. The goal was to get to the code requirement. This gets to the code requirement because everything in here is optional or by staff and the board. It's not mandatory. What troubled me with the old procedure was that it was mandatory. A whole lot of steps that you shouldn't have to follow, like appraisals on property, regardless of the size. But I also understand just following the code is never wrong, right? It's never wrong just to say we follow the Virginia State Code, and that's how you've simplified your policies in other respects. It doesn't leave anything open to interpretation or argument.
I'm fine with this as long as we consider putting forward. I'd like to have the options of that we finish this process. And it sounds like in the first sentence that I know we can just say to you, hey, and then you can initiate.
Absolutely.
It's the same way it could work. I'm fine that new language with that inserted in. I also have an opinion.
I think Mr. Campbell and Mr. Buffington make a really good point about maximum flexibility. You don't know what we're going to have to deal with or what a future board of directors will have to deal with. You don't know the circumstances which we might want to, we might have to sell something. Hope that day doesn't come that we have to look at it that way. So I think the most broad reference to the state code requirements with an underlying SOP, as Tony pointed out, would probably be the best. I mean, that's where I'm coming from.
You guys concur with that?
Yeah, I'm comfortable with it. I think it sounds like you all feel comfortable if somebody comes and asks, hey, can I buy that? You go, sorry, you can't. And then if somebody wants to be pushy, they can call you or anybody and say, hey, I really want to buy it. And we can have a conversation. Go, no, we don't want to sell it. And, I mean, that's kind of what's happened, at least on the 10 years I've been here. Only, 2 or 3 times ever, I think. I can't remember the situations, but I don't know. So I'd lean more that direction.
All right. Mr. Kelly, are you out there?
Yeah, can you hear me?
Yep.
Breaking up. Yeah, I'm comfortable with that. We've done that in the past. As I recall, the front corner, we were approached for retail and it was brought up to the board and they were kind of pushy. We said no several times and finally went away. And then on Belmont Ridge Road, the water plant there, the acquisition of land there, that's back and forth with the board. So I'm comfortable with, as our council says, that we follow the state code with our policy. So I'm comfortable with that. And thanks, Terry, for pinch hitting for me. Appreciate it.
Anytime. All right. Thank you, Sean. Okay. Sounds like we've come to a consensus.
What kind of motion do you
I don't
We
think
could employ that second motion there as amended to defer to the act.
right. So I want to read that. Just example.
draw the short straw? I move the recommendation to the board to approve the updates to the statement of policy subsection FIN 2.4.1 disposition of real property as amended to reflect the provisions in the state code.
Want to second that? All those in favor?
All right.
Thank you very much.
All right. Our next item is the audit results from our friends at YHB.
Yes, I'd like to introduce Jennifer Files from Young Hayden Barber, our friendly auditors. So she'll go through the audit results from this year.
Thank you. Thank you. Good morning, everyone. Morning to the crowd. I'm excited. I thought maybe everyone showed up for the audit results, but I'm thinking not now. Policy is way more exciting than audit results, but I'm very happy to be here. Thank you to all the committee members, to the board for allowing us to be of service. We appreciate the relationship and the partnership that we've built with Loudon Water over the years. Thank you to Sally, to Donna, the entire finance team, to Brian. A lot of people put a lot of work into the audit process. It's a pretty heavy lift. They do a wonderful job. And I'm happy to be here today to present the results and a very clean, good process. Before I begin, to Brian Newland, who you've seen before, does send his regrets that he was not able to be here in person today. He had previously committed to a speaking event in Fredericksburg, so he's probably on stage at this moment. But we do have with us virtually one of our team risk advisory services team managers, Brad Brozick. He will be presenting our special section and the results of that testing that we did this year in conjunction with the normal financial statement audit process. Okay, so what I'll start with is the overview of the financial statement audit. We did begin our fieldwork on March 2nd. We have completed the entire process and have issued our opinion dated May 14th for the financial report. It is an unmodified, clean opinion, the best opinion that Loudon Water can receive on your financial report. We have also completed a single audit, a compliance audit, the federal awards that have been passed through to Loudon Water. It was about $2.7 million in federal expenditures during 2025. We have also issued a clean, unmodified opinion over internal control over financial reporting and over the compliance of those funds. So no findings, a very clean process for those funds. Two sources of awards this year, about $2.5 million of the emergency management funds, as has been in the past. And then I think $200,000 of additional COVID monies that were utilized that were passed through from Loudoun County. Okay. We have reviewed the ACFR. We have reviewed it in conjunction with the GFOA certificate program to help ensure that Loudon Water continues to receive that certificate of excellence in financial reporting. We did the required testing for compliance with the APA specifications for authorities, boards, and commissions, a number of specific compliance requirements that we test annually for you. We incorporate our risk advisory services team in every financial statement audit process for you, and that covers some of the IT side of user access, the flow of information as it relates to in and out of your computer systems, specifically for financial reporting purposes, how data comes in, data comes out. That complements every one of our financial statement audit processes. It is not an audit of your IT systems by any means. And this year, as we met at the beginning of the process, we did dig deeper. That team dug deeper into some specific user access areas related to the upgrade that was done. And Brad will present those results to you of that special testing.
Referring to?
Yeah, when we met at the pre-audit meeting, the special section that is beyond the normal scope of audit was identified to look at these user access because of the big change that took place with the upgrade. So we specifically looked at the user access and the changes that were made in that system. What you have next in the presentation are a number of pages that cover our required communications. I know that these have been provided to you in advance, and I'm happy to answer any questions you have on them. But all in all, the big pieces of this, on the first page here that you'll see, effective 1/1/25, we did identify that the capitalization threshold for new asset additions increased from $10,000 to $20,000. So that is something that we incorporated into the process as we were auditing to ensure that the new policy was being followed appropriately. We did not identify any significant unusual transactions. As we go through all of the sections of the audit, if we identified anything that was unusual or unsupported, we would report that out to you. The next section is a listing of the significant accounting estimates. There are always estimates within your financial report, your annual report. I think it's important for the committee members to know what those estimates are. We do review all of these to ensure that management has a process, that there's policy surrounding them, what the information is, what the estimates are based on. Then we would report to you if we had any concerns or issues with those estimate processes. We have no concerns over these estimates, but the most significant estimates are included here. And I apologize, on the screen, that's not as clear with the white wording, so I'll change that for next time. The first one here is unbilled accounts receivable, service that has been provided to customers but not yet billed at the time of 12/31. The second is the pension and other post-employment benefit liabilities. These are estimates, but they are provided based on the pension and OPEB reports that go through census and audit through the VRS. Depreciation expense, certainly all of the assets are provided a estimated useful life, and those assets may or may not live as long as management estimates in the process. The next piece are the audit adjustments. All of these adjustments are management provided entries. And there's a listing a few pages back that you can look at the individual entries. We need the trial balance very early in the process, a solid month to 6 weeks before that field work date actually begins, so that we have time to properly plan the audit process, the risk assessment, the materiality, all of the things that go into before we start asking for information. So with that, because we need it so far in advance, there are still some items that are being closed by the finance team between that point and when we actually begin the audit process. So we've listed out some of the items there, the fair value adjustment for investments, the accrual for vacation leave, some capitalized assets that were accrued at year end. We do look at all of this information. Obviously, we audit all the pieces of it. We look at the journal entries, the support behind them. We have no concerns or issues with these entries being made. This is purely timing based on how early we need the trial balance to start the risk assessment and when the final trial balance can be done.
So 88 million, that's a big number.
It's a big number, but we'll go a few pages forward and look at the entries. It could be smaller. We could wait for the trial balance or use a later preliminary trial balance until some of these year-end close processes are finished. However, I think it would put compression on your finance team to then put the audit in a much smaller window. And your audit's a big audit. So it takes a lot of population sample testing to be done. Starting the process earlier, I think, gives them a little more breathing room to close things out while we're doing the risk assessment. And they can, once everything's closed, they can jump. We've already made some preliminary sample populations, have those provided to them, and they can jump right into pooling selections and support for us.
Do we know historically, each year when we've done the audit, how much we've had to make adjustments on these misstatements? I mean, is this normal? Is it 50 million, 60 million, or is this an outlier?
It's normal. And one of the biggest entries we do, we always wait till the very end, is the reclass of availability fees to contributed capital. So it's just moving it from one account to another account. And that's $90 million of this, these changes. So that's always done last.
Thank you.
Otherwise, we have to do it again if there were changes.
Yeah. And a piece of this too is the VRS information, the timing of when they provide those final numbers to you. So there's just some things that are going to take a little bit more time to get the information. In the corrected misstatement area, there was one item identified during the audit process this year. Again, identified by management, not something that we tested and found an error that they didn't find. But this item is not, the journal entry was not done to put it in the prior period, if you will. So the amount is $862,000. Essentially, there were 2 accruals booked at 12/31/24. So let's say the same invoice accrued to be paid twice, 2 different GL accounts. And then certainly in 2025, one of them was paid as it should have been. The other, we did confirm, was not paid. The other item was identified as being an accrual that was made that did not need to be paid. So that adjustment, that 862, I don't want to say it's not included. It's in there. It reduced your current year expenses by the 862,000. Technically, the expenses were in 2024. And then we've reduced the expenses for that same number this year. So by the time you hit 12/31/25, your net assets is as it would be without the over accrual and then the reversal of that accrual. It's just in two different periods. For $800,000 compared to the size of Loudon Water as a whole, we did not feel it was material to do a prior period adjustment and put that number back into 2024's numbers. Any questions on that
So that was just primarily the timing,
timing?
what I'm hearing.
Within the accrual and accounts payable area, at year end, there are invoices that have come in that are booked in accounts payable. And then there's also an entire review process that finance does to make sure that anything that has been acquired, incurred, there's an estimate to that to make sure that they get accrued in the numbers because they are due. Maybe the invoice hasn't come in yet. Sometimes invoices don't come in for a few months, but the item, the transaction, just if you will, has been made. So this one item, I think it was in an accounts payable piece and it was accrued because it was known and added in there, but twice.
So we bought a piece of equipment in December. We know the bill's coming, but we don't get it till January of the next year. So we have it booked in our accounting system, identifying really this is coming out of 2024, not 2025, even though we're paying it in 2025.
Correct.
And specifically for this one, we did that twice
Yeah,
for the same invoice. So it happens to be a retainage payable. So it was sitting in retainage payable. And then we said, oh no, this is a 2025 invoice. We need to accrue for it. So we did it twice. So too thorough. But
And this doesn't happen every year. This is more of a one-off. But again, we did verify that the item was not paid twice. It was only paid once properly. And management did identify it through their review processes. Next page here goes through some of just the overall pieces. We had no disagreements with management over applications of or principles of the judgment, significant matters, or the scope of the audit. We are not aware of any consultations management had with other accountants or auditors. No significant issues arising from the audit were discussed, management, and no difficulties performing the audit. Certainly, if any of these things existed, the committee would hear from us well before now if there were any items of this nature. Next page goes through independence. Certainly, we are required to be independent with Loudon Water and the board and the organization, and we are. What we've included in the attachment is a copy of the representation letter that has been signed by Brian and Sally to show what they have represented to us through the audit process. Mainly that they've provided us all the information we've requested. They've not withheld information from us, things of that nature. This is a listing. You currently have 3 gas fee pronouncements that have been issued but are not effective yet. First 2 will be effective for 12/31/26, and the last being effective for your 12/31/27 year. 103 relates to financial reporting improvements. There's a couple of pieces in here that we will look at and work with Sally on if she needs any help or guidance on them. It could have some tweaks to your MD&A and possibly some change in the presentation of the proprietary fund statements. I don't expect any major changes at this moment. We'll certainly work with your finance team if they have any questions as they implement that standard. Disclosure of certain capital assets. And I think your footnotes already check most of, if not all, the boxes of what's required in this. But we will also work with them just to make sure that everything in the standard is updated for your 12/31/26 annual report. And this in very small scale is the listing of adjustments that have been posted through the audit process. So I like showing this, and it's a lot of information, but I like showing this in this fashion so that the second column from the right, you can see, if you were presented 12/31 preliminary amounts, financial results, you have the net income that was presented in those early numbers. I apologize, I don't have the date that you actually gave us that initial trial balance, but probably late January, early February, my guess. So that's the initial number. And then you can see through the course of this.
Which is what the 108, is that what it says?
The 196,552,837 is the very top number on the first line item, second column. And as you go down through these, each one of these adjustments may have an impact on ultimately net income of the authority. So the right-hand column, the amount change column, that shows you the impact on net income for each one of those specific entries. As you go through here, though, the first entry is the fair market value adjustment as they're reconciling and closing out the investment accounts. There was an adjustment needed to get an item to fair market value. So that was the first adjustment with a $300,000 impact. Second is a smaller entry for deferred lease revenue income. The third, as Sally mentioned, is the most significant is the availability entry. Internally, day to day, it's held in one account, and then at year end, the adjustment is made as necessary. So that's 90 million of the overall entry. The fourth entry there is the vacation and sick leave accrual, depending on how much people have taken, and the final accrual amounts for the year-end payroll. That adjustment is made there. The fifth entry is for the capitalization of some assets based on year-end accruals. So as they close out and try to capture all of those 2025 purchases that haven't been paid for yet, then also step two is determining which ones are expense and which ones should be capitalized as part of an asset or a group of items that will become, one larger asset in 2026.
Can't exactly read it from here. Amount change, is that what it is?
Correct. Yes.
So amount change, when you look at those numbers up there, how do you get to 90 million?
So throughout the year, when we get in availability charges, it's to an income account, availability income, and at year end is the only time we true it up and we move that bulk out of income into contributed capital. So it's reducing that net change.
Okay.
By that amount, but it's still in, I'll show you in the ACFR, it's still in contributed capital. It's still a net positive on our books. It's just a different section of
It's just not income.
It's not income. It stays for future payments of our capital.
And that's the 15 million to the 31 million. That totals up to 90 million.
Yes.
But then what's the 106?
That second to right column is just tracking the actual net income, the current year net income as you go down through there. So the preliminary trial balance at the very top had 196 million. And then each one of these changes on the right column change that second to right column to track the trend. So when you get down to the very bottom of that second to last column of the net income loss, it's 108 million. So that's the number that you will see in the ACFR as your current year net income. So it just, the overall change is 88 million, the bulk of it being from that availability piece, which again is still assets and items in, but it's not current year income.
Am I correct in my understanding from what I'm hearing? It sounds like we do this, the biggest one here, the 90 million. We pretty much do this every year. Like we'll see this in all of them because it's just the way it has to be based on timing.
Yes.
I guess in theory, we could spend that 90 million. Is that the correct assumption as opposed to not spending it and then it flows under the balance sheet as opposed to being in the income statement? That's my accounting from 25 years ago, 45 years ago, sorry.
Yes, when we spend that 90 million, it will flow through
Okay.
the income statement, like you said. And we could true this up every month. We just only do this at year end. Kind of like the timing of the assets and the timing of the invoices also. We make sure it's right at year end. If you're a public company, you're going to be doing that every month to true it up.
But that's a great question. What you're describing is really the matching principle. These things are going to be longer term. And then in 26, 27, 28, when expenses are identified and the spend is going to happen, then these amounts will then offset so that you have a match of revenue and expense in that.
Well, and the logic behind the 10 fees, we've always said growth pays for growth. And so the logic behind that is that we're kind of reimbursing ourselves for capital we've already put into all this infrastructure as opposed to being income in the strict sense.
And then the pages that follow is a copy of the representation letter that has
I'm
already.
sorry, Mr. Kelly, did you have a question?
Yeah, just real quick, so it sits in contributed capital and that is reduced over time. Or can we invest that contributed capital? Is that invested? I mean, that's money received.
Yes.
Is that right? It's not an accrual. It's actual money received.
Yes. Yes, we have the cash, and that is largely what's in and when you see your investments, that's largely what that is. Yes.
That's what I thought. Okay, thank you.
Any questions overall?
Jennifer, my apologies for not being there in person. Thanks again for a terrific job and very thorough report. And also congratulations to your firm for being named Accounting Today's 2026 Best Accounting Firms for Technology. So that was
Thank you.
very helpful to have you go through the HANA conversion and your findings and so forth. As I read through that, having been through many conversions in my past, that's not unusual. That's yet people who are testing the system and so forth, and just kind of forget to drop them off at the end when the system is implemented and fully functioning. So good report, and thank you, Sally, as well, and the finance team for all your work in this. As I hear Jennifer's report and as it goes through her findings and so forth, I'm comforted by the fact that staff found this or staff found that it wasn't something the auditors had to find and correct. So thank you for being diligent to you and your staff and providing the board with very comprehensive and accurate information.
Thank you, Mr. Kelly.
So at this moment, I can certainly take any other questions you have, and we can put them at the back end. But I want to take a moment to turn it over to Brad Brozick, who's on the call with us, to go through the special section. This is separate and different from the financial statement audit. And in this process, I'll let him explain what they did because I don't understand. Thank you, Mike, and your team for answering all the questions and helping them get through this. But in our world overall, change equals risk. And when you have significant changes, either with personnel, with policy, with process, or internally within your systems, we evaluate those changes to determine, does it change the risk assessment of the organization as a whole? We do that every year when it comes to the financial statements. And more and more, we recognize how important the technology and the systems are that you use, and the security of those systems. So this was one area that, management committee board had questions and concerns with, and that our team was happy to help and do something different for an independent verification of, you've had talented team and consultants help with the change. And this was just, we weren't involved in the change, but Brian, Brad, their team came in and looked at some of the things after the process. So Brad, I'll turn it over to you.
That's a question. Sounds like we asked for this special part to be done, right?
That's correct. Typically at the audit committee meeting, Ms. Files will walk through all of the regular process, and then either management will recommend to the committee or the committee will have an idea for a special section. In the past, they've looked at oversizing, they've looked at accounts payable processes, they've reviewed, well, we do inventory every year, but they've looked at inventory. They've done a lot of other in-depth reviews, and having gone through a conversion from one software system to another, we felt that looking at the internal controls that were put in place by that transition would be a good special section this year. We did that the last time we did a major conversion about 11, 12 years ago. And it was very helpful. And so we recommended that to the committee, and the committee endorsed that idea.
Thank you. I'd like to see that we're asking for more with this. It's helpful. Thank you.
Good morning, everybody. It's nice to be here. So I will very briefly touch on this page, but I'll spend most of my time on the next 3 pages after this. But so here, this is really just giving you an overview of what our goal was coming in. So we sat down with Mike and his team to kind of figure out where the risks were with the conversion process, get a good understanding of the process, and then figure out where our time was best spent. We decided to really hone in on the assignment of composite roles, which I'll talk about in the next page. The assignment of administrative or privileged roles, and then at a very high level, how they're performing the user provisioning process. If you go to the next page, please. All right, so I put a lot of words on this page, but I think the most important thing here is at the top, these first 3 bullet points. So this is describing how permissions are assigned to individual users, and to understand our comments on the next page, these are really important. So individual permissions, like the ability to create a journal entry or to upload a journal entry, those are what are called transaction codes in the S/4HANA system. When you combine a group of transaction codes together, you get a task role, and that purpose is to fulfill a specific job function for a specific user or a specific employee. And then at the highest level, you get a business composite role, which is a group of task roles that come together to create something like the GL processor role. One thing to note is that an individual user can have multiple business composite roles assigned to them. So they can get those different roles for different access and for different processes. So if we go down to the next page, to the findings and observations. All right, so we looked at 16 different business composite roles. We focused primarily in the finance and financial contract related responsibilities and the roles that were created to address those responsibilities. That ended up giving us vision into 293 different user assignments. Now, as I said before, an individual user can have different roles, so it doesn't necessarily mean we looked at 293 different employees. Our first comment here is that we found that 50 out of those 293 user business composite role assignments were provided to a user and went beyond what their job function required. So while management had done an initial review and gone through the conversion process, some of these were missed because they didn't necessarily go into the detail of the task roles and the individual transaction code permissions. So our recommendation here is to just conduct a more periodic review of all end users assigned to each business composite role, and then go that step further and look at the individual task roles of those composite roles and how they might be affected by the users they're assigned to. So for example, you don't want a user that is front facing that might not necessarily need GL access to have a role that gives them the ability to create GL entries. So that's our first finding. If you go to the next page, our second comment here, this one's really drilled down in, and it's somewhat similar to the last one, but it's important because it could present a potential separation of duties conflict. So we found that there is a business composite role, the budget approver composite role, that's been assigned that specific task role that you see there, GL journal entry process. As part of that task role, the users get the ability to perform journal entry related tasks. And it's very likely that that ability falls outside the scope of 22 users that have been assigned to that particular budget composite role. And it does present a potential separation of duties conflict. So very similar to the previous finding, the recommendation is to just review this particular composite role and make sure that the intent behind it meshes with the permissions and the task roles that it's being assigned. So those were the only, sorry, go ahead.
No, that's okay. Go ahead. Thank you.
No, I was going to say, so those were the only two findings, recommendations that we had, but I'm happy to take any questions if anybody has anything.
Thanks, Brad. The one thing I will add to bridge this piece back into the financial statement audit, because in their process, specifically the piece with journal entries, we do audit journal entries every year in the process. But then once seeing this, that there were additional users that were unexpected to have access, we did a second pass through journal entries and specifically looking for any of those users. And that testing came up with none of the users that fell into this role, into this, even though they had the access within the system to create or approve a journal entry, none of them did create or approve a journal entry in 2025.
People, if I'm remembering correctly.
Yeah, I think that was.
We searched 22 people. They didn't approve any journal entries. They didn't make any journal entries.
But they could have.
They could have, but
Right.
they had access in the system to do so. They did not. And again, this to me is important from the fact that when you think about internal controls, segregation of duties, the fraud triangle, the easiest thing an organization can do to prevent or detect fraud or errors from happening is to limit the opportunity, to limit the access. So that's why we look at user access within the system in every audit that we do for you, because if an employee does not have the ability to do it,
They don't need access.
So we want to make sure that employees have enough access to efficiently and effectively do their job role, not too much access that they could do something that is not anticipated or expected in the normal function of the position.
What is a ZZ? I mean, can you go over those? One is finance, general ledger, journal entry. What's the ZZ? Right.
We have Mike here.
I'm going to pitch this one to Srinivas, who is actually the expert in the SAP system. ZZSM stands for?
Yeah, this is SAP provides standard roles that starts without Z, but we need to customize those roles because we cannot disturb the standard role. If something goes wrong in the configuration, we have to go and fix it. That's why we always need to copy the standard role. That's why we use the G. That is a common standard for anybody who is using SAP.
Yeah, that's what threw me off when I was reading. What is this? That makes some sense.
Thank you.
And no problem.
Is there any update on this from our side? Like,
I'll defer to Mike, but yes.
have we implemented any recommendation or?
So all of the findings that YHB found and Brad and his team found as a result of their review have been fixed. They were fixed by April 10th. Most of them were fixed in March. This particular one, the second finding, took a little bit more work and review with the finance team to confirm that those users didn't need that access. And most of those folks, by the way, are managers and leaders in the organization. Who wouldn't know how actually to create a journal entry anyway. But anyway, their access has been removed in consultation with the finance team. So they no longer have that access. And that's true of all of the other findings as well. So all of this has been remediated. In addition, we're standing up a process, or actually I should say, readopting a process that we had previously to periodically review roles and access in SAP. So we'll be doing that biannually. The first time we'll do that is in July. The next time we'll do that is in January. We actually used to do this prior to the S/4HANA upgrade. We dropped it a few years prior to the upgrade because we weren't making a lot of changes in the system. And so there just wasn't a whole lot to review, but it's a best practice and it's something we're going to continue going forward. But we feel with these changes, frankly, this was valuable to us to find these things and remediate them. And we're going to establish a process going forward to ensure this doesn't happen.
Thank you. Thank you, Mike.
Thank you, Mike, and everyone who helped in that process. And again, I obviously am not an expert in this area, but if you have additional questions, Brad is on the call. He's happy to take the questions. And Brian is also always available should you or anyone have questions specifically on these items. They're happy to be of service. We're an accounting firm, but oftentimes, this is important to us. We have an entire team dedicated to help us in the financial statement world, but they do a lot of other things. So Mike, Brian and his team are always at your service if you need anything.
Your point about user access is well taken, and I don't expect anybody to know this number off the top of their head, but it sounds like we had 22 people that had access that didn't really need it. And so does anybody have I'm just curious, how many people in our organization do have access and so forth? Is that like 50 people? Is it 10 people? Just trying to even understand. I don't expect people to know this off the top of their head, but honestly, is there a magnitude or something?
Yeah, it's less than 10.
Yeah.
It's, yeah.
Do you?
Mm-hmm.
Absolutely.
And that also goes through another level of approval. So even if someone makes a journal entry, it goes to their manager to approve. So you've got to check there.
But it's something like that.
It's probably
Less than that.
less than that. It's probably half of that. Yeah.
That's great.
Yeah.
My general recommendation outside of the system, but it applies to the system, is when giving out access to any new employees or employees who have changed roles, give them the minimum that they need. If there is a part of their job function that they can't do because they don't have access, they will reach out to IT or their leader or whoever they need to gain access. On the other side, if you give too much access from the beginning, chances are they won't call you and tell you, I can see payroll and I'm not supposed to see payroll. They don't call for those types of communications, but they will always reach out if they can't do their job function because it was too restrictive from the beginning.
Good point.
They're on the side of caution. That's where they came from.
So overview of audit results, presentation. I'm happy to answer any questions that you may have. And we are available to the committee and the board and management year round. If you have questions or concerns, please don't wait until one of these meetings to ask questions.
Thank you.
I think we're good. Yeah. Thank you. Sean, do you have anything?
No, thanks, sir. I'm good. Appreciate it.
Okay, thank you, Jennifer and Brad. This is the best day. We get to see the ACFR for the first time, annual comprehensive financial report. I may be the only one excited, but I think Donna's as excited as I am. So I just want to start with a thank you. This doesn't just happen from me. It takes so many players at Loud and Water. And I do like to read what's actually in the ACFR on page 3 when you get to it. This report has been accomplished with the dedicated services of the Division of Finance. We would like to express our appreciation to all employees that contributed to its preparation. We would also like to thank the board that remains committed to fiscal integrity and financial leadership. So I'm talking communications, IT, business solutions, O&M, human resources. Donna Kovalyak is back here today. She's been with Loud and Water 14 years and is our accounting manager. She does an amazing job. She runs this process. Peyton Lanham is one of our newer financial analysts, and she actually did the SPIDA note this year. We gave that to her because she handles the SPIDAs. So we have a great team. It is a big lift, as Jennifer said, but it's also so good when it's done and we get audit results. So here's our theme. I'm going to hand it off to Sue Crosby because this is her baby with the theme. So this will be the cover this year. Sue?
Yeah, thanks. So this year's ACFR theme centers on building a more resilient water future and really highlights our efforts at Milestone Reservoir. Community obviously depends on a reliable water source. And to strengthen our water resources and prepare for future challenges, as you know, Loud and Water is transforming a retired quarry into a raw water reservoir. Milestone Reservoir will store more than 1 billion gallons of water during normal conditions, ensuring that supply is available when it is needed most. So the theme is further anchored by 4 key words that capture the value and impact of the Milestone project, and they are sustain, protect, endure, and stabilize. And on each of these divider tabs has one of those words and describes what it means.
Thanks, Sue. Yep. We get so excited because we do all the numbers and all the notes, and then we don't see the pictures till last week. And so when it comes in, it's a big accomplishment. So thank you to our partners at Apertures too, who take the photography and help us put this all together. Okay, so we're just going to do a really quick walkthrough of all 108 pages. We'll just do some highlights so that you have the overview. So the introductory section has our letter of transmittal, which is signed by Brian and myself. We have the board pictures. I don't know why this isn't moving, Nathan. What am I doing wrong here? Maybe I should use those little arrows at the bottom instead of. Like there's a lag. I'm going to go down and do these down here. This might be easier. Okay. Okay, so there's your lovely board pictures. There's our GFO certificate. We will, once we're not done yet, once the board approves this in June, we'll submit to GFOA and they do their review to make sure that we've met all the requirements for that certificate. There is our organization chart. So that's the introductory section. There's another bubble that Sue was talking about, one of the 4 from the theme. Then we have our independent auditors report, clean opinion, as Jennifer said, and then this is our management's discussion and analysis. So assets did exceed liabilities by 2.2 billion. That is referred to as our net position here. It's mostly our 1.7 million is our investment in capital assets. That's the majority of that. Net position did increase this year by 108 million, which is 5.2% over prior year. We can move on to operating revenues. really hard to move this. Okay, so there's our changes in net position. So operating revenues decreased 27 million or 15% when you look at prior year. And that's because of that easement agreement in prior year that was not recurring for this year. Water and
42 million, right? So
Mhm.
it goes, okay.
Water and wastewater, good memory. Water and wastewater revenue experienced an increase due to the rate increase and increasing number of accounts. Water usage actually decreased a little bit. Irrigation volumes did drop last year. Operating expenses in the middle here increased 5.9 million or 7.3%. And that's attributed mostly to increases in contractual services. So our purchased wholesale water and wastewater. Total operating expenses went from 80 million last year to 86 million this year. Depreciation and amortization increased from 70 million to 75 million. And non-operating expenses representing interest expense increased from 6.7 million to 7.1 million. And then we also had contribution to and from governments here in the lower section. And the majority of that is our contribution to Nova Parks for the assets that we built. Capital contributions went from 107 million to 119 million. And then other highlights, customer growth was higher than budgeted. So we had 4,907 ERCs versus 2020 ERCs that were budgeted. Total availability was the 94.7 million. Principal and interest paid on revenue bonds. This is, we have a chart on the next page here. Those are all our assets and our major contributions. Here's our debt payments going out to the future. So 19.2 million for the current year, and outstanding revenue bonds as of the end of the year is 166 million. Our investment portfolio, 445,936 million with an average yield of 3.68 in 2025. So that's management's discussion and analysis. And then we start the notes to the financial section. These are all our cash flow statements. Many thanks to Jan Heidenbarber and Donna for working through our cash flow statements. There's our OPEB trust fund statement, then our notes. So then we have many pages of notes, and then you get to the statistical section, which is fun in the back. It has a whole bunch of operating, and I don't think I can get there because I don't have a keyboard, but those are the sections. What questions can I answer on the ACFR? It's still draft, so until your board meeting in June, we won't finalize it. So if anyone does happen to find a mistake or a correction, we're happy to change it. We do. So once it's approved by the board, we do submit to GFOA, and then we do all of our compliance submissions. So our banks get a copy, our bond, the holder of our bonds gets a copy, Loudoun County gets a copy, BRA, our loans, the people who.
The Commonwealth gets a copy.
Yeah, so there's a whole list that we submit to.
Charles, or this was just like, you know, in the shuffle of things, you know, so much information going through there.
I would say more in the former of what you described.
Yeah.
Quick question. And I think we got this in the audit item a little bit earlier, but the contributed capital from the availability charges this past year is what? I think that was that the 90 million figure?
That's the availability piece of that, yeah.
It's for last year. I'm just looking up last year's summary points, and availability charges allocated to contributed capital total 80.8 million. So that was last year. This year it's 90 something. Okay. And I'm always interested, as you know, to track the changes in that. And I would say at some point, but not yet, we'll see that go the other way.
Yeah, you'll see in my next little, the financials that we are behind ERCs, but hold tight because come next month, we'll be ahead again. So we did get a bunch of connections in this month.
Okay. And then your average yield on investment last year was 3.43%. Do you have a figure for this year?
Say 3.8.
3.68 last year. Let's see. Yeah, I have the I have the quarterly investment review. We are currently at 3.81
Okay.
as of 3/31.
Thank you, Sally.
And going higher.
A little bit. I just bought one for 4.5 coupon rate. Yay, so that's the ACFR. That's pretty exciting.
Great job.
Yeah, it looks great.
Me.
Great job, Sue.
Okay, one more item, just the financials, please. Okay, so last item is our April draft financials. These still are draft just because we haven't run depreciation fully yet. So operating revenues totaled 44.8 million, which is above the forecast of 41 million. And then non-operating revenues are 17 million, which is behind our forecast currently, and that's the availability fees that are lagging behind as of April. Now, operating and non-operating expenses down here are 58.9 million, and that's below forecast by 4.1 million. Capital contributions are 11.1 million as of April 30th. Then here's our ERC trend. We're at 715 as of the end of the month, which is a little bit behind. And you can look at the trend here. You can see how, the prior years were just.
Do we know how we do it in May? You alluded to it.
Yeah, we got I think we got 4. Did I write it down? Just checked yesterday.
4.
765 connections.
Wow.
So yeah. That's good. And then as of those connections, the majority are still data centers, the blue. And then a look at capital expenditures. We spent 37.6 million, but our forecast was 55.8 million. So we're spending 67% of our forecast. And then we break that out between what projects are user rate funded versus availability funded. So those are the charts there showing you those breakouts. Any questions on April?
Anyone have any questions on April? No? John, do you have any questions on April financials?
Nope, I'm good. Thank you.
All right, thank you. All right, that concludes this meeting. So I'll entertain a motion to adjourn. Reluctant motion. All those in favor?
Just having so much fun. We don't want to.
All right, thank you.